Well, good afternoon, everyone, and welcome along. My name is Reese Williams. I'm the Head of Client Services for the Australian Stock Report, and we've got a very special presentation here this afternoon. So, thank you, one and all, for tuning up. So, this is live, it's interactive. We will be covering around about 30 to 40 different stocks. We'll also be taking some questions. I've got some questions here already. Basically, the rule is the first in, first serve. So, we will be having a special Q&A session towards the end of the presentation, but let's get going because we've got an awful lot to talk about. So thank you very much for joining. Now, very simple to actually participate in the event, and we do encourage people to do so. Ask me a question. Now, it could be a question about a stock that we cover. It could be a question about a stock that you have. It could be a question about a stock you're not sure of whether you should still have it or you're looking to buy. So fair enough. How do you ask me a question? Very simply, come up to the top right, click on this little orange arrow, out we go. Here's a dialog box. And you can see there with the red arrow points, type your question, point and shoot with your mouse, type the question. Once again, first in, first serve. We've got a very large turnout here this afternoon. We've got a whole heap to talk about, and it's also coming up towards the end of the month. This is always a very busy time for us here at the Australian Stock Report, but also the market itself is providing us opportunities, but there is still some areas that people need help with. So let's get those questions answered. Now, to make sure you can still see the presentation, simply click again on that orange arrow and you can slide that back into its little home there, and we can get going. Now, if you are having any kind of technical issue, please give us a phone call, 1300 720 292, 1300 720 292. And I've also got a first question up here from Wendy and Dennis asking us about Telstra. What should they do with it? Funny enough, we will be talking about Telstra because it is so important to a lot of investors. And I suppose the telling thing about Telstra, it's very important as an investor to understand there's some better ideas out there. We are looking for some better stock. So let's get going. So once again, before we do start, we've got to take care of the housekeeping. The basic rules are, and I'm sure everyone's familiar with it, the information that we present this afternoon is only general in nature. It certainly should not be taken as personal financial advice. When it comes to past performance never is a true indication of future performance, and you should also consult with your own independent financial advisor to ensure that the market is the right place for you. Okay, so have a good read and let's get going, and let's get into the good stuff, and let's have a look how the market's been going. Look, certainly we've had a very good start to the year. We can see over the last 1 year the ASX 200, well, we're still maintaining at the moment above 6,000 points. That's a good news story. Okay, so we're up quite significantly from a sell down towards the end of the year last year. However, we've also got to understand that unfortunately a lot of investors out there, Australian investors, they haven't positioned their portfolio in the right stocks, in the right sectors to ensure that they've actually enjoyed the ride. Now, we'll also have to look at the broader picture here, the US market over the last 1 year. Once again, we're looking at a market that's really rebounded, and this is from the sell-off that was in the last quarter last year, built on concerns about the trade war, built on concerns about the international economy as well. And since we've brought that up, it's important for us to go through and actually see where the international economy is sitting right now. That's important for us over here in Australia because we get pushed and pulled around. So we really have got a very large melting pot of different concerns that have really added volatility to the market. Thank you very much, Jill. And Jill and Paul are asking about Fortescue and also about the volatility. We'll be covering those stocks off in just a few moments. But firstly, let's just make sure everyone here understands how the trade wars, how the Brexit concerns, how the Eurozone, Chinese manufacturing, we'll go through that. The PMI numbers have missed the mark. That's a contractionary sign. Okay, so we are talking about an international slowdown. Does that mean that your gains, your income have to slow down as well? It certainly doesn't. You need to know where to invest. So we are looking at an economy that is bracing itself for a further slowdown on the basis of a reduction of consumption. Consumption helps the world go around. Okay, so we've also got to have a look at bond yields here. Very important, even if you don't know much about economics. Please understand this. At the moment, the bond yields are signaling a further contraction globally. And the reason why we see this is that we've got bond yields going up. We've got an inverted bond graph at the moment. We'll talk about this in just a few slides actually. But the most important thing to remember is when the market is signaling to us that it looks like there is a slowdown, make sure you are in the right stocks. Now we've got to really balance that off with the fact that most of the reserve banks around the world, or the central banks, they are looking at reducing interest rates. I'll talk about that in a moment. The reason why it's going to be important for you as an investor in the market. So let's keep going. Now a little bit closer to home, we do know that, oh yay, yippee yay, we've got another election coming up. Okay, so Australians, we really do go to the ballot box quite often, and we have to, otherwise you'll get a fine. But we've just come off the back of the New South Wales local election here, and the state election. But this is about the real deal. This is the federal election, and everything really is pointing towards a fairly solid Labor win. And this is the reason why there's a lot of big companies, big institutions, who are already changing their future strategies to actually make sure that they know that there will be a change in the way that investors may be investing. And because of the fact that Labor have got a benchmark or a pledge, one of their key pledge policies is to make sure that they actually do change negative gearing and also change to franking credit refunds. Now that's got to do with the excess franking credits. Now, whether you agree with it or not, the fact of the matter is that there are a ton of Australian investors, self-managed super fund investors, who have based their future strategy on that policy. And this all of a sudden is a change. It's an impending change. This is the reason why we have got a whole heap of people looking for some solid information, some strategies that's important about where to invest, taking into account that there could be a change in franking credits that will affect you, dividends. Okay, we also know the property market itself in Australia really is starting to come apart at the seams. Well, look, when we say that, we don't mean it's going to crash, but we certainly are saying that it's really not very attractive at the moment. And what we do know is that we've had a very good run with the property market here in Australia. The big banks have done extremely well. And this is actually, thank you very much for the question, Graham. This actually brings up a very key question. What should you do with the banks? Now, the bank's really where you want to be invested for the next 6 to 12 months. More of that as we go through. We have got better sectors, and you've got to understand that the banks have made an awful amount of money over the past 8 years, profit after profit, and the reason because they have made huge advances in their lucrative loan book. Lucrative once upon a time, now it's time. The tide's turning. Okay, especially when we are looking at the strong possibility of another interest rate cut. Where are the banks going to make their money? So more on the banks as we get going, but the fact of the matter is that the market generally is a more attractive vehicle for people to invest in, and the reason for that is because it's more liquid, much quicker and easier to sell your share portfolio down than it is to move a property off. And we've got a number of people who are probably in the midst of trying to move a property at the moment. Now, over the ditch there, the Reserve Bank of New Zealand, they've already signalled just yesterday that they are looking very likely to have a rate cut here. And so Mr. Philip Lowe is probably, we think, in the same predicament. We believe that there will be an announcement with the next Tuesday, the 1st of the month, which is very close. And that announcement is really going to be about a very dovish sentiment. This has happened in America as well. So interest rates go down. What happens to the market? Well, the market will go up. Okay, which part of the market will go up? Well, that's the hard part, and this is what we do. We help you out with. Okay, so you also may have heard the word recession. It's been a long time since this word has actually been booted around in the media. And the reason why recession has come up once again is because there is a global slowdown. We know that. We understand that. We've also seen the inverted bond yield. We've also got some interesting signals from the money markets as well. We've got the property market slump. The difference here is, and for those of us who are around in the market, or just simply you had a mortgage in the early 90s when the interest rates were sky high and we had jobless numbers more than 10.8%, we certainly did have a recession. Wasn't that drawn out. The main difference here is that this really is a symptom of quantitative easing, and that goes back to 2008 with the GFC. Now, the big takeaway here is we do want to remind people is that the interest rates are going down. So in the past, when there has been a recession, interest rates are usually sky high, which in turn will create joblessness. This is not the situation at the moment. We do believe that there's an opportunity for a fairly significant pullback in the market. But as an investor, we all know this is the time when you can make a truckload of money if you know the right sectors to invest in. We'll talk about that in a moment. Now, two things on the global scene just before we jump into some stock selection. The first thing is Chinese manufacturing PMI, that's Purchasers Managers Index, tells us what the economy as a whole are doing in the aggregate. What are the companies buying, stocks, inventory, and also German manufacturing numbers are down. Okay, so this is a bit of a problem. So we've got the Chinese manufacturing PMI, there we go, it's missed the mark. January 2019 was around about 48. The latest numbers have come in, bang, around about 46, but also the German manufacturing PMI is just above 44. This has well missed consensus. Consensus was around about 48. So this is a contraction story. This is a contraction story. And the reason for this is because Germany, for example, one of the leading exports obviously are cars. Mercedes-Benz, BMWs, Porsche, Volkswagen, and so on. And there we go. So we know that with that huge change in the middle class in China, that's actually starting to peter off. So maybe they're hanging on to their expensive European imports a little bit longer, even though with your VWs you may have some problems with the old DSG gearbox, and I've had my share of problems with them as well. But it's obviously a sign, okay? It's a warning signal about what the market's doing. Now, what does that mean for our market? What does it mean for your portfolio? Well, there's good news. And the fact of the matter is that we are still remaining above 6,000 points. However, the stocks that are coming to the fore, they may not be the traditional income stocks that you've done very well on for a long time. Those days have kind of gone. And I'll give you a very good example. We only have to look at the big four banks. And we know that everyone in this presentation today, you probably have got a very fair exposure to those big banks. What should you do and where should you go? We've got some better ideas for you as well. Now, we are also saying that if you are in the market, we are saying to our members 10 to 15% of cash is a wise decision to have right now. You need to be ready to scoop up the bargains. Where will be the bargains coming from? We are looking at innovation. We are looking at mid-tier industrials with some good income. Now, the fully franked component of stocks may not be the be-all, end-all, which it has been for years. Okay, we are talking about a change of composition in the market. Okay, mid-tier industrials, innovation stocks, technology stocks. However, in order to actually make those gains and reap the rewards of actually looking over and above your traditional boring stocks, not only are they boring, but some of them are going to go backwards, we need to find some better ideas. Now, back to that franking situation. Some of you will know, and you've also maybe signed our petition, but we've got over 41,000 signatures for our franking credit petition. And this petition really has been driven by our thousands of members who want to make sure that the politicians understand that we do not want a change to the actual current policy as it stands. And the reason for this is it's not about fairness and equality between classes or investors. It's really about what it may do to the market. So we've also got some of the big research houses out there. We've also got City Index or Citigroup, sorry, and also Macquarie saying that they do foresee up to a 20% decline in some of the big financials on the back of the franking credit change. Okay, so this does affect us. The good news is there is a way that we can actually combat this, and one of them, of course, is signing the petition, but the other is, of course, making sure you pick up our reports. And we've got a very, very special report for our members, and we'll talk about that in a moment. It's called the Franking Credit Survival Kit. And we go through a number of different ideas that you, as an investor, you need to make sure that you've got the right strategy. And the fact of the matter is that most people don't have a strategy. Okay, so we're looking at things like property trusts. Property trusts, they don't have a franking component, but they are, part of the infrastructure story, really. And they are also attractive when you've got very low cash rates. So remembering that interest rates are probably going to go down again, people need to find a safe place to park their cash. Where will they go? We think property trusts will be a very good story. Utility stocks, we'll talk about some of the stocks and current buys that we've got on at the moment. International shares, okay, now cross-border investing really has come back to the fore, with people thinking that I need some better opportunities, and there certainly are some really good opportunities there as well. And we'll talk about what we can offer, and we can also talk about the reasons why the US market, for example, have really outgunned the Australian market over the last decade. Okay, so we've got to go through and make sure you understand how to price a stock. That's what we do here at the Australian Stock Reports. And we'll also talk about hybrids. We've got a whole heap of questions already about people who have got hybrids, concerned about what may happen to them, how will they perform if the franking credit policy is changed. Okay, so that and more very shortly. And we've also got, towards the end of the presentation, we've got our preferred income stock. Okay, so these are stocks that have got growth potential, but they've also got significant income, and we think it's a safe place to be. So very quickly, before we jump into some more stocks, I want to go through and make sure you understand some pretty good strategies, and just in a broad sense, we'll talk about our dumbbell strategy. Okay, dumbbell strategy. So here we go. Here's Peter, and well, he's got dumbbells, and it's probably not the right strategy to have at the moment, because what we need to do is make sure that your weighting is in the correct parts of the market. So how do you do that? Well, you do this. Okay, so you get rid of the dumbbells and you actually pick up a barbell. It's a barbell strategy simply because of the curve here. You can see on the chart, we're going to section this off to low risk, risk in the middle, high risk at the end. So this really is similar to a way that maybe a general would actually play the field for a battleground, for a theatre of war, similar to what you do in the markets. Okay, in the middle we've got the kill zone. Okay, so we've got low risk down here. These are really stocks like your infrastructure stocks. We know that they're not necessarily that attractive. They're a bit boring. However, they are where you preserve cash. And a lot of people here, you may have a self-managed super fund. Your job is to maintain your nest egg. You've worked very hard to make sure you've got that money there. Do a better job of actually keeping hold of it. 80% of your portfolio, we're saying, look at utility stocks, property trusts, infrastructure stocks, 80%. Okay, in the middle, financials. This is where the financials lie. At the moment, this is where they are. We think that if you were to buy the financials at the moment, at current levels, you're probably throwing good money away for no necessary reason. Okay, high risk, we've got the 20% of your portfolio. We're looking at tech names. Now, interestingly enough, over in the Dow Jones, in the US space, pun intended, is we're looking at space exploration stocks. Okay, and this is really an extension of what's happening in the technology space area, and we'll go through some of those ideas as well. But they really have been some huge returns. We'll talk about some stocks that we're going to give you at the moment. So this is all about being agile. It's not necessarily about being active. We know that most people are looking to hold on to investment for 1 to 10 years, maybe longer. So we don't want to be buying and selling positions all the time, but you certainly do want to take the money when it's there. Okay, and as a reminder, the franking credit survival kit, we'll talk about this strategy and more, and that's also what we give. It's a very in-depth, well-researched article, and it really is a manuscript that we believe that most investors, you need to understand what's written in there. Not only is it about making money, it's about saving money. And we'll talk about that as we go through. So very quickly, megatrends, we spoke about this before, technology, innovation. This is where the retail space is heading. We know that retail, bricks and mortar retail, that really is a thing of the past. Why? Because we've got these. Telephones, well, mobile phones. And they have revolutionized the way that we live. So you can order a taxi or Uber. You can order food. You can order anything. You can order a date if you like. Everything's available on your phone. And this is where technology is leading, and you're looking for companies that can harness that technology, leverage off the back of it, but they can also make real gains in the way of operating profits. And we'll talk about the way to identify that using our Halo system. So we'll talk about the individual stocks as we go through. Tech stocks, here we go. Here's some of the stocks that we've got on the books at the moment. I'm also going to go through a brand new recommendation out there for everyone as well. But firstly, let's go and have a look at Appen APX. Okay, Appen 53%. Cloud storage, okay, 53% since we gave it as a buy. Bravura Solutions, there we go, same thing, 73.5%. Very nice returns. These are tech stocks, and obviously when it comes to valuations, they maybe are not the easiest things to value, and the reason why is because they don't run off your traditional metrics. So I speak to investors all the time. People have been in the market for 40 or 50 years. They can't make hide nor hair of these stocks, and this is the reason why things are changing. Aristocrat Leisure, well, this is still technically a tech stock. We all know what they do. They're a pokey outfit. 90% total gain since we brought this one on. And Altium, ALU. This one here is a whopper, and we've had that for about a year, and well, not even a year, but just 13 months. There we go. 184.2% total gain. So once again, remember, these are the type of stocks that you'd put into your 20% of your barbell strategy. And we have got some brand new recommendations that I'll go through as well. So if you haven't already got some tech stocks, have a good think about it. And I'm going to show you another one here, and it's a very interesting story indeed. The stock itself is called Splitit. SPT is the stock code, and this is really a competitor to Afterpay. Now, have we got Afterpay in this presentation? Okay, now Afterpay is a stock that's up around about 500% in the last 2 years. But Splitit, they really are very similar. They are operating in a very similar way as Afterpay. So this is a Israeli-based installment payment company. It is listed over here on the Australian market, but it's a really good story about the way that you value these companies, because you can miss some great opportunities. Remember, I was saying that you should be agile, not active. If you make a really nice return, how about cashing some of this in? So how do you price these companies? Well, it's all about revenue minus expenses. You're looking for net operating cash flow. Okay, now net operating cash flow is very, very different from net profit. And the reason for this is because it's money in, money out. It's very transparent. When it comes to net operating profit, you can always fudge the numbers. So this really is unfudgeable. So Splitit, let's see how they've gone. Okay, April 2017, $13.90. At the moment, $16.74. Now I want to show you this. This is supposed to come in after I actually went through the second stage, but if we can go back just very quickly, I wanted to bring up the actual return on this. But anyway, look, Splitit itself, it's getting up to around about 900% return. Okay, so they're supposed to have a return here and it wasn't there. But very quickly, moving on to some other tech stocks, and this is still a tech stock, Computershare. You probably have them. If you have a look at your share registry notes, you've probably got some mail in the post from them. Computershare, CPU. We gave, we gave them as a buy for $13.90, 2017. At the moment, $16.74. Now, I will draw your attention to the right, and you've got the blue triangles. Now, I'm going to show you what these blue triangles mean in just a moment, because this is part of our charting software. And more than charting software, we've got some very advanced software that we give our members here, our members have access to, and it'll help you time your entries, and we'll find you some very, very nice buying opportunities as well, but also when to sell. So Computershare, everyone knows what they do, their share registry, but this is actually topped on a healthy 26% since we gave it a buy to our members in 2017. Okay, so it's a nice number. Once again, this is a company that's really maximized their global reach over the US. That's actually making up some very nice returns in the way of their long-term contracts. It's up around about 10% over the last 2 years. So Computershare at the moment, it is still a buy. $16.74. We suggest this as a buy still to our members. You have not yet missed the boat on this one here. Okay, so CPU. The next one that we're going to look at here is Service Stream, SSM. Now, we gave them as a buy originally back in 2017 for $1.47. You can notice here, once again, you've got the blue triangles. The blue triangles, I'll just let you know this, they signify a buy. Okay, so this is where our software is actually saying this is providing good value, it's time to buy. The basic rule is the more triangles, the stronger the signal. We gave them initially as a buy with our research team, 2017, $1.47, $3.70 today. They are a technology company that's operating in the telco space. They've got a big long-term contract for the NBN. Even though the NBN really has been a failure overall, it's created a lot of income for this company. Their increase over last year's financial year data was up around about, 30%, 29.6% to $33.5 million. So we're certainly seeing value in this business, and once again, this is really like infrastructure stock as well, because let's face it, fixed communication is important. It's the way that economies grow, it's the way that cities grow. So ServiceStream is a stock that you could consider. As you can see, it was also given as a strong buy signal with a Halo platform. It's still a buy today. You can actually find all the buy information, or the buy, hold and sell recommendations in our members area. Okay, very quickly, you can't win them all. Kogan.com, KGN. This is a stock that has really been pummeled, and the reason for it going down so sharply is there has been a little bit of fundamental noise around the fact that you've got the founders actually selling off a huge tranche of their actual individual holdings. That usually can be a bad sign for the stock overall. The PE is fairly high for this type of stock, and their earnings growth rate kind of missed consensus, missed the mark. So we're looking at a stock that's actually dropped about 50% in the last 6 months. Now, we actually went through and actually gave this as a buy recently as a turnaround story. So it actually has picked up its game since we gave it as a buy, but it really is about buying a value proposition at the moment, because we think that with a further downturn in retail space, you will get downstream value companies like Kogan. So we're looking at discount companies actually picking up pace. So if we go back and we have a look at every time the economy actually starts to slow down, we have a look at those value or basic based brands such as Aldi. They will start to actually gain pace. And it's just part of that psychology. When people feel the economy is slowing down, they start to tighten the purse strings and they look for some cheaper alternatives. So Kogan is something that we are certainly interested in, and have a look at the buy recommendation for this, but we think it's been punished enough. It's a turnaround story in the making, and have a good look at the recommendation. It is a buy. Okay, moving back to another tech stock, Appen, and this is the chart that I was trying to bring to you before. APX, since we gave them as a buy April 18, $8.89, they're up nearly 68%. Okay, now what we actually did do, and this is part of being agile, not active. Okay, we picked them up in April, and then October of last year we actually took 40% off the table. Okay, 40% off the table. And this is what we call a scaling out strategy. And the reason why we did decide to go through with a sell is because we had made a significant return. We also looked at some of the fundamentals behind the story, and we thought, well, Appen's had a good run. It is trading on some very lofty multiples. The multiples were above 30, so we decided to take profit and see how it went. And we are lucky that we did, because it dropped over 30%. Very shortly after, and there we go. These are the indicator triangles, the blue triangles. They're a good sign, and we decided to go through and pick this one up again. And since we've done that in January this year, so we've had that for about maybe another 2 months now, we're up a further 57%. Okay, so once again, we understand that investing is a long-term game. We certainly don't want to be in and out of the market all the time, but we don't want to give away good profit. Okay, agile, not active, we want to take some profit off the table, and that's what we help you with. Okay, so Appen itself, it's still looking like a buy at the moment. So you probably won't get the outsized return if you'd had jumped on it originally when we gave it to our members as a buy. We still think it's well worth it. It is within that 20% space of the barbell strategy, so it's a high risk stock, but it's certainly a good story about innovation and about how these companies can actually generate some real revenue streams as well. So let's dial back the clock a little bit and go and have a look at some of the big blue chips that most people here would be fairly familiar with, and it's the big banks. Okay, let's see how these banks have been going. Now, there could be some further downside from the Royal Commission, from some of the, from some of the key findings that the Haynes report came out with. The fact of the matter is that we're yet to see those findings actually put into action. And sometimes it's a little bit like going to a garage for a quote for your motor car. They'll give you a quote for $500. When it comes to pay it, it's more like $2,000. It can still be the same. So it's regulatory concern, and also about how they are actually going to initiate some of those recommendations as well. So the banks have had a pretty hard time. Let's have a look over the past 1 year. NAB, you're down 12.5% if you've got NAB. ANZ down 5.2%. CBA, you're sitting pretty, 1.9, remembering that this does not include income, so this is a capital story. But overall, you're looking at a sector that really has done its dash. This is what we call sector rotation. Okay, sector rotation. So Jenny, thank you very much. She's got a question. I'm going to read the question out right now because it probably does relate to everyone in this room. She goes, well, thank you very much for that, Reese. What do you think we should do with the banks? Should we sell them now? We are not saying to sell all your banks. We are simply saying not to buy any more. not at the current levels. Okay, if you were really hung up and pretty assertive about getting yourself some banks, make sure you don't already have them. Also make sure you don't have a dividend reinvestment plan burning away in the background, because what you are doing by default is buying the banks every time they come out for a dividend. It's a lazy way to invest. You are completely ignoring the thematic of the market, and you're completely ignoring fundamentals. Do yourself a favor, turn that off, get the cash instead, and use the cash to buy some other stocks in a different sector perhaps. So there's a lot of ways that we can help you. Have a strategy. Number one rule, and I was actually reading in the Financial Review just the other day, from a survey through financial planners, ASIC actually have found out nearly 70%, or 64.5% in fact, of people with a self-managed super fund trustees, they don't have an adequate strategy. You have to have a strategy. Okay, very quickly, let's go and move on to the materials space. It's also very important. It will never go away. BHP, Rio Tinto. Rio Tinto's had a tear for the last 24 months. They've done very well. And it's on the back of iron ore, obviously. So iron ore at the moment, $87 even. And this is where we'll talk about Fortescue Metals for those who've asked us. Look, overall, we are still on a long way back from normal. We do have to be mindful of the fact that China is slowing down some, and this is obviously going to impact on the iron ore price. So what are you looking for? Rio, you've done 27% in the last 1 year. Very nice. FMG, this is a standout stock. It's a volatile stock, so we'll talk about that one in a moment, but that's 59%, and BHP is up at 31%. Now the big takeaway story about all these producers is that they have got very strong pedigree, and what I mean by that is that they produce some very high, fine quality iron ore. This is something that you cannot find anywhere else in the world. We know that BHP, for example, they've had some blips, certainly with dams breaking and the tragedies that have ensued. At the end of the day, though, these are very, very solid companies. Now, would we be tempted to go back in and buy them at the current levels? Not right yet. They are under review. A whole research and analyst team, they are looking at these companies right now. We are looking to see a foundation in the base metal space before we actually do pull the trigger. There are a ton of opportunities in this area. We do have some very good buy opportunities in the lithium space still. But if you are looking at buying some of these resource stocks, probably hold off for a little while. We think you could possibly get them for a better price. If you've still got them, well, you've done very well. Hold on to them. Hold on to them. Very quickly, we'll go through and have a look at gold. Gold always is something of interest, especially when we are looking at some choppy markets, especially when we are looking at volatility. So gold has always been a safe haven. And with the fact that money printing is not occurring in the larger economies like it once was, we believe that we'll see a return to normality with that gold price. So at the moment, 13.17 is where it's at, US. Remembering that every time the Australian dollar takes a backward step, which it has done recently on the back of the New Zealand Reserve Bank saying that they're actually going to look at winding down interest rates, our dollar lost steam. It's a very good story for our gold producers over here in Australia. Here's a one-time favorite. It's been around for a long time. You probably have it, Newcrest Mining, NCM. And look, we really do like Newcrest Mining for the simple reason that they have done such a solid job of turning around their prospects. They've done such a solid job of actually making sure that they lighten that balance sheet. We've seen improvements over the last maybe even 5 years of up around about 20%, and that's very fine numbers. But remembering that as a key producer here in Australia, they're going to benefit every time that Australian dollar steps back. So this stock here, a very, very good story. $25.56 at the moment. You do need to make sure you've got some gold stocks on your portfolio as part of having a balanced, diversified, fortified portfolio. This stock here, 29% we've made on it since we gave it as a recommendation. Include your dividends, 31.3%, not bad. Is it a buy today? It is. It's still a buy. And as a reminder, we will be going through and actually giving you our preferred gold stock towards the end of the presentation as well. So Newcrest Mining is a buy. Okay, now we'll just go through very quickly. I'm going to mention another gold stock as well, just to give you another bonus. And this is Regis Resources, RRL. Okay, it's 42% in the last 6 months. 42%. It's been on a tear. And the reason why we actually did pick up RRL, which is Regis Resources, is because they are really a takeover target for Newcrest. They've got some very, some of their mines are very close in geographical location in Newcrest Mining, but it's really Newcrest, their balance sheet looks so strong that they will be in the mode for buying very soon. They are looking. There's a lot of companies out there in this space who are looking for takeover targets, and the reason why is because they need to make sure they've got a long enough pipeline, and a good key way to do that is through mergers and acquisitions. Okay, oil in the last 3 months. So oil has been once again very volatile, $50.60 at the moment. The last 3 months, we can see it's formed a perfect pullback. It's a perfect V on the chart here. So what does this mean for your portfolio? Who has Santos here? Okay, so there we go. We've got a number of people here who've got Santos. And the question really is, what should you do with it? Now, look, we like Santos as well. We've had it for a long time. We know that oil is really a bellwether stock, and it tells us a story about the global economy. That's important. Look at this, Santos on the chart. You can see that we've got the blue triangles over here on the left-hand side. That's a buy recommendation. We tie that in with our analysts from our research team, so it's real-life fundamentals applied. But it's done extremely well. It's around about $6.90 at the moment. Santos. Why is Santos such a good story? Well, the real reason for us making that 40% capital growth over that since we gave it as a buy last year, the real reason is because you are looking at a producer of LNG. Now, LNG really, it's becoming a clean energy source, no doubt about it. And the big bonus, I suppose, that Santos has is that they've got a diversified portfolio of mining sites and a diversified portfolio of different energy sources that they will do very well in the long term. Now, they are volatile, we know this, but we also know that at the moment the LNG natural gas price is linked to the Brent oil price with a 6-month lag. And what this means is that when oil drops, or when oil accelerates, the price picks up, you will have to wait 6 months for that to be played out on the natural gas price, okay, the LNG price. Now, what that does is provide you with a window of opportunity. So if oil dropped significantly next week, you've still got a little bit of time there with your LNG to actually make a decision to exit that stock. But the other thing is that we do believe that sometime in the near future, LNG, because it's becoming quite a heavily traded commodity, will have its own pricing structure soon, which will make it very interesting indeed for key players like Santos. So we do like Santos. You can see that we've had some further iteration of buys here with the blue triangles earlier this year, and it really has proved to be very lucrative. Okay, and that's the Halo platform. I'm going to show you how that works in just a moment, and the reason why thousands of members here of the Australian Stock Report use it every day to make better investing decisions. So Santos, we do like it. It's got a buy on it at the moment. It is one of the high risk stocks, but we do have a buy on it at the moment. If you've still got it, we think it's maybe, depending on the return you've had, obviously, it could be time to take some cream off the top. Okay, so it's had a significant run, but it's certainly something well worth considering as well. So very quickly, Australian Stock Report, who are we and what do we do? So we are Australia's #1 premier stock selection service. We work mainly with self-managed super fund investors or people who do their own stock selection. We are here to help you. We are information providers. We provide a service that we believe is #1 in the market. So we've got a team of highly paid, highly skilled analysts. Tim Montague-Jones, for example, who heads up the research team. He used to head up the Morningstar research desk, and he also still holds the Longsec Award for one of the most successful hedge fund managers. Okay, so he came across to us from Macquarie Bank. We've also got our own managed fund. We also have a corporate finance finance arm as well. So we have got a whole plethora of different desks and services here, and we are the biggest in the market in Australia. Okay, Atlanta Pacific Australian Equities Fund, just very quickly. It's been ranked #1 out of the last out of 340 funds by Morningstar for the last quarter. You can see that here on the report. This is for people who are looking for a managed fund. Okay, so obviously we do have a lot of different type of products here, but it really has had some stellar outperformance of late. Nick Byron, who you'll see here in the picture, he's actually our head hedge fund manager, and he's also the brains behind the Halo platform. So he's designed a platform that is what he uses to find those stocks. They have placed us number 1 out of 341 in the market, and this is what you have an ability to use as well. I'm going to show you that in just a moment when I give you some further buy recommendations. We've got an office here in Sydney where I'm broadcasting from live today, and we've also got an office down in Melbourne. I'll be there tomorrow, and we do encourage all our members pop in and see us. The fact of the matter is the clients who do the best with us are those who are not shy to say hello. Come in and meet us, talk to us. We don't give you personal financial advice, and that's not what you want, but you do want some solid insight into those stocks. We can give you strategies. We're here to make you money. If we make you money, you stay with us, and that's the reason why we do have 83.7% retention rate. Okay, significant. Tim Montague-Jones, I mentioned him before. He's also here. He's one of our superstars, and certainly he was one of the key drivers behind the great performance that we had 2018. We took away the Australian Stock Picker of the Year award by the Australian Stockbrokers Foundation, so we're very proud to have that, and we are hoping to do the same this year. So, and maybe we can help you actually get some good returns as well. So member benefits, we give you the daily financial commentary. This is black and white information. We show you the indicators on Halo, but the big part of the service really, I mean, of course we give you buy, hold and sell recommendations, but a big part of the service is for you having access to speak to someone impartially about the market, remembering that our favor is for you. We need you to do well, to improve on what you're doing, and this is the reason that we've got thousands of members. Okay, we've got around about over 10,000 members at the moment. So let's go through and have a look at some of the reasons why we believe, number 1 stock picker here in Australia. And we'll go and have a look at what you receive as a member very quickly. Every morning you'll receive the daily market update. That's just black and white information. Talks to you about where we're looking and why, and it really is about you keeping your finger on the pulse, making sure you understand where the market itself is going. Let's go and check out some of these recommendations. We'll go through. We can't fit the whole lot into that one screen, but let's go and have a look at Macquarie Group. We're talking about the big banks before. Now this is a bank that we've done sensationally well with, and the reason why is because Macquarie Group at the moment, I mean, we're up nearly 100%. We're up now not 95% since we gave it as a buy. And one of the reasons that we did really favor Macquarie Bank, which really is one of the premier investment banks, it's not a retail bank, we know this. This is the reason why, is because they've done a much better job of actually incorporating a lot of technology into the services. And they are actually going after that retail sector, the retail business sector, the retail banking sector. And what you will notice is that they've closed down a lot of their branches. It's not good news for the Macquarie workers who are maybe working on these branches, but it is good news for the bottom line. So we've seen an increase there of about 25% in their net operating profit over the last 3 years. It has been a very, very good stock. At the moment, it's it's pretty lofty at the moment, but it's certainly something that you should keep an eye on. We'll be reviewing Macquarie as we go through. Because we're waiting for some more financials to come out and we can go for another buy. But if you've already got Macquarie, hopefully you've done very well. Hold on to it. So here we go. So a big part of what we are saying to our clients at the moment, we have people coming in all the time, every day. We speak to people all the time on the phone. It's all about rebalancing your portfolio. And as I mentioned before, we are anticipating that there will be a short-term pullback. And this is good news. If you know what you are doing, there are some stocks there that you've probably had some runaway success stories with, that maybe you should look at taking some of the profit off the table and actually dipping that money into some other sectors. Maybe the tech sector, for example, I mentioned, or some of those infrastructure stocks, property REITs. Now they are looking very attractive, even though the property market itself is turning down, remembering that the property REITs really talks about the retail commercial space, the commercial space more so. This is the reason why we are finding them interesting. Okay, our advisor team, remembering that you've got phone coverage here, pick the phone up and speak to us 8 o'clock in the morning to 6 p.m. Monday to Friday, or come in and see us. Our door is always open. And even if you are looking at a stock and it's a recommendation you've heard from a friend down the pub, or you've heard it on the news or read it in the newspaper, please give us a call first, because we may know a little bit about that stock, or it could be in a sector that we do like, but that's not the company that we like. Okay, there could be a very good reason why we are saying don't buy this stock. How about Appen. How about something else in the area? Okay, now here we go. This is really the showstopper part, and I'm gonna show you the reasons why. We've got thousands of our members using our Halo platform. Now, what is it? It's a very advanced analytical tool that has been designed by a leading hedge fund manager. We're the only ones who have got it. We'll spend millions of dollars developing it. It covers 1,500 stocks. Okay, so basically every stock on the ASX, and soon to cover also the US and international markets as well. Right, what it does is it forecasts. This is a forecasting tool we are about to actually go through and launch this as a white label product for other advisors out there. But it's designed with a retail user, mum and dad user in mind. It's for you guys, and we've made it very easy to use. Let me go through and show you how it works. Okay, I'm going to go through and click on that Halo tab. And there we go. The first one that we're actually going to analyze here, it's a good old favorite, it's Telstra. Now, I mentioned Telstra before, and I've got a question here from Ramondo asking, is Telstra a buy at the current levels? We don't think so. We would like it to become a lot more cheaper before we actually ventured into buy. The reason why is because Telstra has got a hangover legacy based from the fact that all the years that they made huge profits, they paid it back out as dividends, and this is the reason why it was a crowning a superstar in a lot of people's portfolios, but it never gave them much opportunity to expand or reinvest back in that company. They were busy buying up everything left, right and center through acquisitions, and you've got to put money into those acquisitions at some time. So Telstra, we sold this off nearly 2 years ago, and it did really caused quite a stir with a lot of investors. And the reason why is because it's been, as I said, it's been a favorite, so reliable with the income it pays you well. That stopped being true. And we can see here that you've got the triangles on the screen, but these ones are upside down, and they're also red. So that's telling you it's a sell signal. And you can see the concentration of the sell price there up around about $6. It's been entirely accurate. So we tied this in with our fundamental research from our research team, and we're more than happy to sell it. Okay, so we can see that even at the moment, what it's trading at is, it's not a contender. If you've still got Telstra, look, there's some better ideas out there. So remembering that the red triangles on Halo are that's certainly a sell. So $3.30 at the moment for this particular stock. There's some better ideas out there. Spark New Zealand is certainly one of them, and we'll talk about the reasons why. But this is the other compelling thing about Halo. It does so much, and I can't really show you everything because we'll be here all night, but very quickly, this is the reason why people love this. It gives you financials. It gives you all the details of how that company is tracking. And what I showed you before is a short signal. Okay, we'll just go back very quickly. I'm just going to show you this again. The reason that the way that this platform actually decides to give us a buy or a sell signal, it's based all on some metrics that sit behind. It's an algorithm. And it really is about making sure you understand moving averages. So we basically have a very simple rule, and it means that the monitor to buy and sell will be triggered where we've seen the price trend has been positive and earnings revisions have been positive. So every time they've come out with an update, the earnings revisions are still pretty good, and that means it's going to be a buy signal, and reverse is true for a sell signal. Okay, so this is some of the details behind the way and the reason why this platform is so accurate, and it's all about making sure that we've got some very definitive data, some definitive information, so we can make some definitive decisions. Okay, now I just want to go through and just show you this very quickly. EPS. What does EPS stand for? Earnings per share. Why is it important? Well, it tells us what that company's doing. Are they still generating enough income? Are they still operating in a way that is possible to continue growing that company? But more importantly, can they continue to pay you out those dividends? Okay, now firstly, earnings per share, we can see that there's been a reduction. This is on Telstra. I've highlighted in red here. In 2016, it dropped it was going to go down 5.2%. 2017, you can see this 0.7%. 2019, that's nasty, 33.7%. It doesn't get better for some time. This is the reason when we're saying we are not interested in Telstra at these current levels. Would have to see some further downside before we actually got remotely interested. So this is what we call a capital trap stock. A capital trap stock. Remembering that you're buying Telstra and those income-bearing stocks basically for the income, but you do need some capital growth. There's no point buying something for income and then the capital dissipates. That makes no sense. That's not the way that you invest. Okay, now I'm going to show you another metric here, and it's dividends per share, which is DPS. I know some of these terms may be brand new to you, but this is what analysts look for, and our job is to make sure that you understand how this works. And this tells us your dividends per share is actually growing, the momentum here. And we can see in 2017, it stalled. 2018, it went down 51%. Remember, when Telstra lost 30% in their income, they slashed the dividends. Well, they also lost over 30% in the capital price and the share price. Okay, so now not only is Telstra showing us to be a capital trap, it's also showing us to be an income trap as well. It's not a good story. Okay, John, and I'll answer that question in a moment. But just going back to this chart very quickly, here we go. I'm going to overlay some earnings per share. Here we go, EPS rolling 1 year forward in the purple. And we can also see earnings per share. The way that it works is that you're looking at a portion of a company's profit allocated to each share of a common stock. And earnings per share serves as an indicator of a company's profitability going forward. So it really is a key indicator. And we can see that as that stepped down, well, so did the share price. Now this is what Halo can actually afford you. All that information plus more. It also can do forecasting on dividends, which is extremely important. How many times have you picked up a stock? I remember a couple of years ago Woolworths did the same thing. And Woolworths was also a very, very nice income stock, and then they slashed their dividends by around about 20%. Okay, now that's a surprise that you cannot afford to make. It also went backwards by quite a large margin. Turning around now, we understand that, but you need to make sure that you're looking at buying a company with a nice dividend, but it's got a better metric behind it to show that it can reliably pay that dividend into the future. Dividend forecasting. This is something that mum and dad investors unfortunately don't know enough about. So expected dividends, how does it work? Now very quickly, I'm just going to show you this as a mock portfolio, but we can do this for your portfolio. What we do is we load up your portfolio onto the platform, and it's going to actually pull it all apart for you. It's going to give you on-demand information specific to your portfolio. How is it tracking? How is it tracking in relation to other investors? How is it tracking in relation to what other brokers are saying about your particular portfolio? Now if you have a look at this chart here, it looks like, well, I don't know, some maybe a scarf that your nana used to make you, but all those colors there, the color coded, they represent a stock. And for this portfolio here, which I think is around about $1 million, for example, it's just showing you where your dividend is going to get paid and how much it's going to pay, and also who's the biggest payer, okay, relative to the size of the block of the color that represents that stock. Now this is key, because when you're investing, you've got a portfolio, you've got to run it like a business. Okay, it's an asset generator. Well, it's an asset itself, but it's generating your income. No different from having a investment property portfolio. You need to see where the money's coming. When can you go on holiday? When can you splurge some of the inheritance? Or when can you actually buy some other stock? Tie it into reporting season, for example. The reporting season really is one of those times where you can pick up some whoppers. Get some stocks that have been sold off too sharply, for example. Now just very quickly, we'll go back to Woodside Petroleum, WPL, long-term favorite of ours. Very much the same story with the LNG story as well, and the 6-month pricing delay with Brent oil. We can see that we've got a concentration down here on the left hand side of blue triangles. It means buy. We remember that on Halo, and we gave this as a buy originally for $30.72 back in April 2018. At the moment, $34.87. okay, it's also been up towards $38. We still have some pretty positive sentiments on Woodside. If you go through and have a look at the financials, we know that they've got a number of different tenements coming on board and different work in the pipeline that we believe they can continue to outperform even if the oil price goes down in 1 year's time, based on the exposure to LNG. So it is a buy. The full buy report is in the members area. I'm just going to go back and talk about the superstar stock Macquarie Group that we had before, Macquarie Group MQG, and once again we've overlaid the EPS 1 year forward, rolling 1 year forward in purple. Remember, earnings per share. Now, if you had this type of information, just imagine how it could revolutionize your investing strategy. Okay, you have a gut feeling about a stock, you make a decision. That's not the smartest thing to do. Make sure it's actually backed up by some pure Science, we're talking about some metrics here. EPS, so we can see a concentration of those lovely blue triangles. It's a buy. We can see that the EPS, the purple, has been laid over above it, and it's really stayed true to form. This has been a very nice stock. Okay, very good. We're looking at 92%, as we mentioned before, on the stock. And it really is an interesting company. There are a number of other buys in this area that we have coming up as well. Let's go through and have a look. And here's one right here, Magellan Financial Group, MFG. And we can see this is just a wash with those lovely blue triangles. Okay, and they've been fairly accurate. Have a look at the motion of the chart. Have a look at some of the pullbacks and the peaks there. It's pretty much been bang on the money. Okay, and these were the halo buy signals, and we can see what we've done. Okay, so we actually we've actually got a sell signal here, and at the top of that trough, we can see that we bought it back again. Okay, sell, buy, sell, buy. Now, we know that most people here, you're not looking at short-term opportunities. You want long-term investment strategies. But if you were looking for shorter-term ideas, we can take some money off the table and keep on running with it. We can help you with that as well. Okay, so Regis Resources. I mentioned this stock before, the gold stock. Let's run it through Halo and see what Halo says about it, RRL. And we can see that Halo has been very consistent with the buying opportunities. All right. There we go. So 36%, 37% since the last buy signal, and that was in the middle of last year, the last technical entry. It's still a buy at the moment. We are looking at a company that's done extremely well for ourselves. Remembering, if you're looking for some protection, gold is a very good place to visit. Gold's a very, very good place to visit. And we know that most people are here for income, and we know this is very important, especially given the fact that there could be a change in the way that the franking credit excess credits are paid back, and this might affect some people. But it's also going to be a change in the market, because we are talking about sector rotation. You need to understand this. I want to show you a chart in just a moment with some of the stocks that will explain sector rotation in some detail. And we've got a very special income report, Australian Stock Report income report. These are hand selected stocks, and they're chosen for the reliability of income, the fact that they can at least maintain your capital. That's important. We need a safe haven for you to go to. If we get all right, we'll get some stocks that will go up in value, but also deliver that all-important income for you. The average across the report since induction was 6.9%. 6.9%, some very nice. That's grossed up yield. Very nice numbers indeed. Okay, ASX 50, we can see that you'd probably see a number of stocks here that you've got in your portfolio, and we can also see that we've got a number of buys on these stocks at the moment. The key is to be selective. So when we do give you a buy recommendation on a company, we need to make sure that you understand the risks. Always put the risks before you put the profit in your head, and see what the catalyst or the change may be. You're looking for a point of inflection. You're looking for a reason, a compelling reason, why that company will turn around or continue a nice jaunt. So let's go through and make sure you understand what sector rotation is all about. Now, what is sector rotation? Well, it's something that you need to know about, and it's the way that the money runs around the world. And look, it doesn't matter if you've got a $10 million portfolio or like $100,000 in the market. If you don't understand sector rotation, it's probably going to be quite difficult for you. Sector rotation talks about the way that cycles, economic cycles, will be played out in the money markets or the equity markets. And a really good example of that, of course, is the banks. The banks have had a tremendous run. They are what we call cyclical stocks. They are in a downturn at the moment. They are certainly nothing that you'd pick up at the moment thinking that you're going to double your money on. That's not going to happen. So let's go and have a look at some stocks where you possibly could double your money. So over the last 12 months, good old Telstra, okay, we're down, well, we're around about 3.7%. That includes your income there, but it's not very good performance. We compared this with ALU, which is Altium, 63.2% up. Okay, WBC, which is Westpac, we're down 10%. Santos, as we mentioned before, we're up 36%. Very nice. Okay, here's another one of the big banks, NAB. We're down nearly 13% in the last 12 months, or maybe you are. And we've got Appen. It's up 150%. 150. These are real differences to your bottom line. Remembering that we've got a full report out on our next tech stocks. Okay, our next best tech stocks, we've got about 5 of them coming out as well. So also remembering the fact that we know that most people don't have a strategy. Have you got a strategy for a pullback in the market? Have you got a strategy for some better income ideas? That's what you need to understand. You need to look at some of these property trusts, making sure that they're the right type of property trust. They've got the right cash flows. They're in a business model that's sustainable. Bunnings Warehouse Property Trust is one that we've got. HPI, which I'll show you in a moment as well, is another one. We've also got another strategy here for international share investing. This is something that you could consider. If the franking credit, excess franking credit change does go through, it would probably be one last reason why you have to be so centric towards the Australian stock market. There's some better ideas out there. Hybrids, we'll talk about that in that very special report as well. So I'll give you an example of what the Australian market has done versus the US market in the last decade. And we can see that it's outperformed quite substantially. Okay, S&P 200, we're up about 82.5%, which is not too bad, but it's not looking that flash when you compare it to the S&P 500. Over the same time, we're looking at 290%, 280 odd percent. Quite a lot. Quite a lot. Okay, and the reason for this is because dividends. It really is all about dividends. Over there, it's all about capital growth more than income. They really are a capitalistic society, and this is the reason why they've done well, but also remembering that they've been printing money for a long time. But there really is some really nice stocks over there, so you could consider picking them up. Now, very quickly, I've got a question here going back to infrastructure stocks and oil part of the oil story. We'll have a look at one now, APA Group. Okay, APA Group, you've probably seen this around the track for a long time. They do pay a nice yield. Have a look at the signals on the chart. Okay, you can see some blue triangles and also some red triangles, but we did give this as a monopoly buy because it really does look like they have got a monopoly over on the west coast. Pays a good yield. It's not fully franked, of course, because it is a trust. Well, it's not a trust, but it is aggregate stock. 22.6% capital growth. Okay, since we gave them as a buy. 7.9% grossed up yield. You're looking at a 30% total gain. Is it a buy at current levels, just above $10? We think so. Okay, APA Group. Once again, these are not terribly exciting stocks, but these are the place to park some cash in until we see a bit of a pullback in the market, and then you want to get out there and buy some. Maybe the banks if they go down further enough. Okay, BWP Trust, Bunnings Warehouse Property Trust. This has been a very nice stock for us, and we can see that it's certainly been a buy favored by Halo as well. We gave them as a buy back in 2017 in August for $2.93. At the moment, $3.54. Nice plotter, 25% capital growth. You can't complain about that. At the moment, it's around about 6.1% income it pays you. Not fully franked, but it's still good income. Nice income profile. Over the time that we've held it, 9.1% has received an aggregate dividend. 33% total gain, and it's still a buy at the moment. Okay, remembering that we believe the RBA will come out with some very dovish sentiment, or even Philip Lowe coming out and saying, well, look, you know, we probably are going to cut interest rates again, follow the suit of the New Zealand Reserve Bank governor as well. Okay, so it's not bad. 4.8% net is what you want to look at. Here's another example of these property trusts or REITs, and this one here is Hotel Property Investments, HPI. They've got a fairly big portfolio, around about 50 properties in Queensland, South Australia, and the big news about them is that they actually run all the bottle stores that Coles actually lease, or they lease out to them. They've got some very nice numbers. We're just having a look at the report today that's out there for the members, and we're looking at the portfolio. It's 100% occupied. Okay, that's a very nice story. We gave them as a buy originally back in August 2017, $3.06. And we'll give them again as a buy. More recently, we're looking at a 10% capital growth over that time, plus a 10%, not fully franked, but it's still a very good income. You're looking at 20% total gain over the time that we've held it. Now, do you think that it's going to be a buy at the moment? Well, yes, we do think so, and I wish actually I could run that through Halo and show you the buy indicators on that as well, but we, from a fundamental perspective, we think that's a very good buying opportunity. Well, here's another example of what we call a staple, and it really is. Chicken has become a staple. I think it's the average Australian now, they eat about 60 kgs worth of chicken a year. It's huge. But Ingham's really has been, once again, a staple stock. It's been a very, very good stock for us. Oligopoly again. You've got a couple of competitors there, but they've really got the game stitched up. You've got a gross yield of around about 6.5%. It's a nice story. We gave them as a buy originally at $3.12. At the moment, $4.26. We can see the buy signal in the blue triangle right there. 37.5% capital gain, you can't sniff at that. Okay, 24% aggregate dividend, over 60% since we've had that as a buy. Are we looking at picking them at the moment? Well, yes, we are. Okay, it's still a buy. Now, we're just going to go back into Sydney infrastructure stocks, and I've got this question here from Philip. He's asking about Sydney Airport. Well, you took the words right out of my mouth because we're about to actually talk about it now. Sydney Airport. Okay, so we can have a look at the chart here. And we can see that we've got some buy signals. We've also got some sell signals, and it's been remarkably accurate. But we're going in for a buy now. Okay, so we gave them a buy originally for $6.90. We know that if we see a further fall, maybe getting down to around about 65 cents, the Australian dollar, it's always going to be a very good story for tourism. Okay, here in Australia, $6.90 at the moment, $7.40, 6.8% capital gain, not bad. 6.9% dividend, infrastructure stock, 14% total. It's still a buy. Okay, so some of these stocks, they've had a fair run, and you'll probably want to be selective about it, but these ones here, we think it's still a buy. Okay, now we can't get it right all the time, and I'm going to show you an example of what we do. I'm going to show you an example of what we do when we have to cut our losses, and you have to do this. And this really is a story of that right here. Origin Energy, ORG. Once again, this used to be a darling of a lot of the self-managed super fund investors, and the reason why, because you got a very nice fully franked income. And you had some good capital growth, and that was going back maybe 7 years ago. Okay, we gave them as a buy in February 2018, $8.41 on the back of the sentiment of the oil price. You may remember oil was actually reaching for the stars. On a fundamental basis, we decided to sell this off, and this is because we saw a lot of negative sentiment regarding the US economy. There was a slowdown. PMI numbers from China really started to loosen around this time. So from a fundamental basis, we said, look, we're going to sell this. We bought them for $8.41. We sold them off at $7.95. So we have realized a 5.5% capital loss. This is what you've got to do sometimes. You are in the market. You need to realize a loss sometimes. 5.5% is not the end of the world. The good news is about Origin Energy, of course, is that when we did sell them off, well, subsequently it slid a further 13.3%. We also had some income along that time, and the income was around about 3.5%. So we're looking at around about 3% loss. That's not bad. That's not bad at all. So Origin Energy is certainly something that we're not looking at. So put the dividends on the chart for this one. Okay, so let's keep moving on. ASR, buy recommendations. What is the stock in the infrastructure space that we are saying to buy? Remembering that we've got a number of them on at the moment. And the stock I'm about to show you is going to be in that 80% part of your portfolio with that barbell strategy. Okay, let's go. Here we go. And the stock is infrastructure. Spark Infrastructure Group Ltd, SKI. You may have this already. Has been a volatile stock in the last couple of months, but we think that most of this is all over and done with. We gave this as a buy originally back in 2017 for $2.52. At the moment, 6.9% capital loss. Are we going to get rid of it? No, we're not. Okay, we are actually going to buy some more. And part of the reason that we did mention we did witness a sell-off, and we decided to hold on to it, is really got to do with a ruling from ATO. So this is one of those fundamentals that can really sneak up, you know, and surprise you sometimes. You can't really do too much about it. We've gone through. We are confident and comfortable with the reason and the rationale why the price has gone backwards for Spark Infrastructure. But once again, it is a stock that we believe if you bought it today, it will keep you in good stead. Even for the ones who bought it when we gave it as a buy originally, it's a buy right now. Okay, sometimes your positions will run behind. This one is running slightly behind, around about 3.5%. That's okay. We are saying it's still a solid performer. And certainly once all the ATO rulings have been rolled out, that's going to be priced into their balance sheet. It's going to look very nice. So Spark Infrastructure, we think at this level, it's a very nice story indeed. Okay, so we're going to go through. We've got a number of questions about different stocks, and I will go cover off some other questions about hybrids, for example. 2019 income offer. It's towards the end of the month. This is a time that people are looking to do better in the market. We are looking at an election just weeks away. It could be just weeks away, and we know that this will move the market because it's all about the big institutional investors. Okay, so what do you need? If you're in the market, you need, number one, capital preservation. Everyone needs it. You've got your nest egg, you have to look after it. Number one is capital preservation. Number two is sustainable income, and number three is capital growth. Okay, these are the three things. You want growth, you want income, but you also have to look after your nest egg, and it's in that order of importance. So what can we do? How do you become a member here with the Australian Stock Report? Okay, we've got reports, and this is where you just get the buy, hold, and sell recommendations. They're very good. You're remembering that we had 6.9% income across our income report. You also get the investing report individually, the $1,497. Okay, each. You'll get 12 months worth of both reports for half the price. So you're looking at 1,497 for both. Remembering it can be or may be a tax deduction if you've got a self-managed super fund, but you need to speak with your financial advisor or accountant. Okay, offer two. This is a very popular one, Halo. Okay, Halo, our proprietary forecasting tool here, $2,497. You'll save $500 from the stick price if you went and bought it from our website. Okay, and you get that for a whole 12 months. Or the third offer, and this is limited to only 30 people, but it's a long-term membership. It's a very in-depth one. You get 4 years of the membership. You get the Halo report, you get the investing report and the income report, plus some bonuses. Now, normally, if you bought these things individually, you're looking at nearly $9,000. All right, sorry, you're looking at $14,000, but at the moment you can save $9,000 by doing a bundle deal. Annualized, you've got your annualized cost down to $1,249 for a year, $4,997 for 4 years, plus these very important bonuses. Okay, so I'm going to go through and talk about the bonuses right now. Okay, the first bonus is you get an advanced course, and the advanced course is going to be with our stock specialist here, and also you will meet Tim Monaco-Jones, who's our head of research. You also read myself, get to meet myself, which I'm sure will be a pleasure. But this is where we really have a hands-on event here, either be in the Melbourne office or over here in Sydney. Jump in, we show you how to work Halo to this optimum level. Okay, so normally if you want to come along to one of these events, it's fully catered as well. Normally you would be looking at around about $300 a ticket. As a 4-year member, you'll get all of this for free. You get 2 tickets, so you can bring your husband or bring your wife. Okay, bonus 2 is that franking credit survival kit, as we mentioned before. It's invaluable for people who are looking for a strategy. Get yourself a strategy before the change in the market occurs, and that's a very in-depth guide. And we'll talk about property REITs. We'll talk about fixed income trusts. They are going to become very, very popular very shortly. Make sure you know how to invest cross borders. We can do that a whole lot. Okay, and number 3, this is a very important bonus, and this is the portfolio review. Okay, and this is where you really need to look at your stocks and have some expert opinions on whether you should maintain that position, buy some more stock, or simply sell them. 1 or 2 tweaks or changes can make a huge difference to your bottom line. So what I'm going to do is just going to roll out a registration page for those people. So I've got 3 offers here, just the reports. That covers 42 recommendation, 1,497. You get it for half price. Offer 2, you're going to get 12 months worth of Halo for $2,497, so you're saving $500. And the most popular, and we've only got 30, is the reports and Halo, plus those 3 important bonuses. $4,997 one-off payment, and that is for 4 years. Ongoing mentoring, and also there's recommendations as well. Okay, we've got a lot of people coming up for questions on that one. Look, what I will say is that we have to go back to the question time. So if you haven't selected one of those options, please go through and do it now. We can invoice to your self-managed super fund and maybe a tax deduction. It usually is for a lot of people. The reason why you'd come on board for the long term is if you've got a portfolio, you do need some help. You know you're going to be in the market for at least 4 years, and you want to get to know us. You know, the very best people that we work with are the ones who actually spend some time getting to know how the service works. Come in and meet us. We have these workshops all the time. With that Halo workshop, you'll be invited to a Halo workshop every time we run them. We run them very regularly. And some of the feedback that we've had has been just absolutely phenomenal. But I have to close down that poll right now so I can go through and answer the rest of the questions. Okay, we've got John here asking about why are you avoiding hybrids? Hybrids have been extremely popular for a long time. One of the main reasons that we're looking at avoiding them at the moment is because the attractiveness of the high yields with the bank hybrids, they're really lost with the proposed Labor franking refund changes. It's not really about mum and dad's been invested in them, it's about the big end of town. We're talking about the other big brokers, institutional investors as well. So if you've got a product that returns maybe a 5% and investors could claim back the franking credits, the distribution rate without that franking would probably be down to around about 3%. And that makes the gloss come off some of these hybrids. So therefore the returns do not justify the risk from our point of view. Okay, so there's some better ideas out there. I've also got a question here from Tom. How does a portfolio review work? Well, Tom, very simply, all you do is you send through an email of your stocks. We set up a timer on the phone. It takes, however long it takes to get through your stocks, maybe 20 minutes to 1 hour. Or come in and see us, and we go through impartially your stocks. We don't give you personal financial advice. It's general information about the stocks you hold. So you could be at a loss with what to do with one of these non-performers, or maybe when to take some profit. We can change that. Okay, now we've got some people saying that they never had a chance to actually select one of those information packs. We'll go through. Here we go. Can roll that poll one more time, please, Torben. So we've also got Gene asking if we've got any more of the 4-year deals left with the 3 bonuses. There's 6 left, and also we've got a question from Tom. When do you run these workshops, and how long do they go for? Well, look, that's very easy. We're here by Martin Place. We run them here. It's all fully catered. You come in, we give you a breakdown. The whole day's kitted out. You'll get to meet all the research analysts. We go through and we talk about undervalued stocks, the reason why you're not wanting a particular sector, and we just spend time with you, make sure that you're comfortable with the market, and we can answer all those questions. But you get to meet these are real analysts that you get to spend some time with. These are people who turn stocks inside and out every day, and you also get to meet all your own advisors. So the people who do the very best here are the ones who actually get to know us and spend time with the advisors as well. Okay, now I've got another question here, and the question is from Gillian, and Gillian and Robert basically got the same question. How much should we lighten the banks by? It really depends on what position you're into. But the other thing, of course, when it comes to your banks, what we are saying, just to reiterate this, we're not going to say, look, run out and sell everything, but you could be in the position where the ATO, the Commission report a year and a half ago, saying that 60% of self-managed super fund investors are overweight in the big banks as it stands. Overweight already, and it did you favors when the banking sector was going up. That's no longer the case. Just change out into some better ideas, and we can help you. 1 or 2 different stock ideas, we can revolutionize investing. So that's what people need to understand. Look, I'm getting the hurry up from my producer, but it really has been a pleasure here. Just remembering that we do anticipate a bit of a pullback coming down the track. It's obviously a good opportunity to pick up some better ideas. Don't be scared of it. Information is important, and we need to. Oh, that's right. Look, I've got a phone number here. If you've tried to select one of the options, you can't get through. We've got a huge turnout here, so please give us a call. 1300 720 292, 1300 720 292, or send us an email, and the email is invest@asrw.com.au. Okay, any questions that you've got. Now, we've got to actually wrap it up. I have actually gone over time. It really has been a great time. We've covered a lot of information. If we can divert that phone to the main switchboard. Thank you very much, Torben. Look, it has been a pleasure. Everyone who's come on board, and we have got a significant amount of people who have come on. Thank you very much for joining us today. For everyone else, I hope you enjoyed it. I hope you got some good information. There is some changes coming in the market, so be prepared and give us a go. 1300 720 292. My name is Reese Williams. Good afternoon, and thank you very much.